Hey, everybody. There we go. We're talking about mortgage rates, right? That was my white man dancing game there. Anyway, just kidding. So here's the funny thing. So mortgage rates actually have bumped up the highest since February. And a lot of folks are saying, what happened? I mean, we're talking a massive surge. We're going to get into that. Hold on. Okay, so there's been a lot going on in the market. When we talk about the market, we're talking about the stock market. We're talking about the economy. We're talking about what's happening nationally and internationally and how that is all coming to effect. Because as you know, the Feds, well, they didn't change rates, but yet, we've been seeing some pretty aggressive, swings here this last week. And a lot of it is tied behind confidence. A lot of it is tied behind some of the tariffs. A week ago, 2 weeks ago, the market liked tariffs. Now there's like, wait, we don't like this new tariff. Now, granted, everything's going to settle out. Yes, mortgage rates will come back down again. Here's the funny thing. When we talk about what is surging, what is happening, as you can see that the chart there, which shows basically since a year ago May, if we blow it up here, you can see we just took a massive jump. But you can also see, it's starting to come down just that tiny little bit. Now, again, it responds to the market. So we had some reports. We had our PBE that came out, right? And we have a few other metrics that came out that, hey, we're better than anticipated. So everything kind of shifted. That left bonds kind of in a downward trend. And then, of course, mortgage rates went up. So there's a lot of things that come into play. The question is, and a lot of people are saying, oh my gosh, are rates going to come back down? Yes, they will. They do. They go up and down every day, multiple times a day. That's why you need to make sure that when you're quoting rate, you're quoting the same time of day and whatnot with people. Make sure when you're quoting and getting quoted rates, you're getting the full picture and what are all of the requirements of that loan program. We'll put the link down below. 5 questions to ask when being quoted mortgage rates. It's a 12-minute video. Watch it 3 or 4 times. Make sure you understand because, well, only watch it if you're interested in saving money. There we go. Okay. And reducing stress in your buying process. Just saying. All right. So when we talk about what's going on in the news cycle, most of it was around mortgage rates. Mortgage rates surged to the highest level since February. Worst 24-hour for rates so far this year. Mortgage rates modestly higher on average, but some lenders are lower. We're going to talk about that. And of course, we see our red mark there where, we took a massive bump in rates. But when we talk about mortgage rates and some lenders keeping down, remember, we have what's called the Fed price. And that's what banks lend to each other every day. That's what banks borrow at. Then they have their margin, and that margin is dictated by what they want for profit. Okay, that's the margin they look at. Normally, it's between 2 and 3, sometimes 1.5 and 3. If you have online companies, sometimes they look at 1, so they can offer better rates. Those all get packaged up. They get put into a big box of other mortgages, and they're sold as a mortgage-backed security to Freddie, to Fannie, who sends them off and repackages them, for insurance companies, annuities, and things like that because of their consistency, right? When you look at it and they say, hey, what's the likelihood of somebody paying their mortgage? Well, it's pretty high, so it's a very safe investment. That's why annuities and insurance companies want them. Now, we're gonna see these things bobble up and down every single day. We don't historically see these massive swings until we see something significant happen in the market, like tariffs. Okay, tariffs and what happened, and that directly translates into the 10-year, not so much the 10-year. 10-year Treasury actually went up, but the 2-year Treasury, well, it kind of went down. And remember, Treasury is how we adjust and sell our debt. Okay, for those of you who say, well, okay, hang on. That is just a very simplified version, okay? It's not an economics class. I'm not going to walk everybody through it. Keeping it simple. The key is rates will come back down, but understand everything is going to evolve and it's going to change. So making sure that you're monitoring what's going on, especially on Wednesdays. All right. Wednesdays is a big reporting day. And like when we take a look at Freddie here. So Freddie, notice I put there's delay because Freddie says, hey man, this is flat. This is their running 7-day average. Well, they didn't trigger the massive spike yet. And because you don't see that spike, you're going to see it probably Tuesday. And you're going to see all of a sudden that big upturn. And then of course, they're coming back down. They're kind of they're their delayed response, okay? But it's a good metric, because they have a nice, easy chart to follow. The one that we show in real time, which was one of the first slides that you saw, that's definitely more accurate and gives you a better depiction. Remember, if you want that, just down below, there's no marketing there. It's just good, solid information for when the time is right for you to make that next move and or doing a refinance. That was not a good time to do a refinance. Just saying. All right. So if we pop over and let's take a look at what's going on in the real estate market, because remember, mortgage rates have the biggest impact on buyers because it's directly out of their back pocket. They take their wallet out. The higher the interest rate, the more they pay. The lower the interest rate, the more they get to save. And so we will watch things ebb and flow. In fact, new construction is actually, that's kind of an interesting one. And we're going to see that. So if we open this up, our inventory is still heading in a downward trend. Market times actually came down 7 days for the same time, month over month, year over year. And that's actually pretty awesome. However, when we pop over and we take a look at what's going on with the running 7-day average with the MLS, hey, look at this. New listings are up 1,151. It's the first time we've had more homes come on market than the 1,050 that went off market. That's the first time that's happened since the first week in October. Before that, it was, there were only, I think, 3 weeks last year where the number of homes came on more than what pended or what went off. We're still drawing down inventory. Now, is that a surprise? Oh my gosh, yesterday, it was unbelievable how many homes that we had to filter through that were coming on market as to who we sent to our clients, to make sure that they only receive exactly what they're looking for. We had gobs and gobs of them. In fact, when I opened up my system, there were like 102 homes for my clients that we had to filter through to say yes, no, yes, no, yes, no, yes, no, and to say, okay, yeah, here are some good options. These get kicked out for a variety of reasons. Now, that is rare, and so we knew that our numbers today were going to be pretty staggering. But here's the funny thing, and this is super important to understand. Remember, overpricing your home. If you're a seller, overpricing your home, without a doubt, is a kiss of death. And new construction sometimes is that indicator because they always have to push price. The biggest indicator of overpricing your home is the REO industry. And we're going to go through that one and you're going to see exactly what I'm talking about when you overprice your home. All right. But they're different. They have to prove to the investor that they got the best price. They just don't realize that it adversely affects them. But I guess if you're just punching numbers, it doesn't matter, I guess. All right. So here we go. So let's take a look at another metric here. Northwest and MLS year to date. Pendeds with multiple offers. Down a little bit. We're down actually 4% from where we were at last year, meaning that we had more multiple offers last year than we did this year. Okay, not uncommon. We had less inventory. We had slightly better rates, especially at this point in time, than we did last year, right? So when we take a look at our next one, I'll blow this up for you. Hang on a second. This is the number of offers with escalations, and we're down about 2% on that one. Only 10% of the homes today are escalating, and 12% last year had escalated. Now, you might be saying, George, why is this important? It's super important because it lets us know where we're at. We have actually seen more multiple offers and escalations in the last 45 days than we did since January through, I would say, the middle of March. Why? Well, because rates were a little bit higher, which has a direct impact on things. And the spring market has definitely come into play because we're still seeing a high level of homes coming pending. And you're going to see that shortly with these metrics. And when we take a look at just the, hey, how many of them are escalating? How many are multiple offers? Well, escalation's down a tad bit, but again, we're starting to see those again. And that's a kind of a catch-22, but that only happens on well-priced homes. Okay? If your home is not well-priced, you're going to sit. And the more you sit, the less money the seller gets in their pocket. The more more concessions a seller has to give up. In other words, if your home sells in the first 7 to 10 days, you're going to get between 100 and 107% of list price. If you miss that mark, you go out to 20 days, you're only going to look at 98, maybe 96% of list price. See, now you've already lost 2 to 4%. Whereas you could have had either A, multiple offers or gotten 100% had you not been as aggressive as you were. And again, when we take a look at the REOs, that is going to be case in point, all right? So keep that in mind. You go out to 40 days, you're only going to look at 92, maybe 93% of list price. Now, that doesn't mean that if you have an out-of-the-box, very rural home, that's not going to be there. That's going to be a little bit more unique. We're just talking about the normal in-the-box traditional homes. The more unique you are, well, the smaller the buyer pool, and that metric tends to change, naturally speaking, right? All right. So if we move on and we take a look at our Northwest MLS, let's take a look at our year-over-year numbers. And this is super interesting because look at this. All right. These are the year-over-year numbers. So the center one is middle of, so month, year-to-date. In fact, let's just blow it up. And here we go. So as we can see, our inventory is up, and we took a big bump yesterday, which took us up to like 23% more inventory than last year. And when we were here, we were only 1,000 homes, so we were about half of that, about 12, 13%. And when we take a look at the number appended, which is the top, the bottom, and say, look, we're 5% more than we were at last year, which is consistent, okay? And when we talk about that translating to solds, our solds year to date are doing very well. In fact, those numbers are all up. However, if we come in and we take a look at just the month of April, even though our inventory is up roughly about 800-ish homes to 11% more new on market, our pendeds are up almost 10%, which is roughly about 200 homes. Here's the funny thing. Our solds for April, they're just struggling just a little bit. It's basically, 30 homes, 29 to be exact. It's one of those things. It's not a horrible thing, but just understand that we're still moving along very well year to date. Even April, it's the 11th, still doing incredibly well. Technically, it's the 12th, but these numbers are from the 11th. All right. So as we roll this into taking a look at new construction, this is where we start to see some numbers deviate just a little bit as far as what's going on in the market. So we look at this, and all of a sudden your numbers are like, oh my gosh, sales are down, inventory is down. What the heck is happening? Let's take the bigger chart here. So when we look at this, top chart is year to date. So the number of new homes coming on market is down about 205. This is Northwest MLS wide. When we take residential only, sales are down about 282 homes year over year. And then of course, pendants are down 480 homes. That number's continuing to grow and is now becoming, I think, a little bit more problematic. We need to reverse course on that one. We're starting to see a lot of builder incentives. We have our red tag sales. We've got our 2-1 buy downs with start rates of 3.99. You're starting to see a little bit of homes coming on the market with a slightly lower price. And so we're seeing some adjustments on that one. Why? Because we're seeing some of those sales slow down, especially with an influx of new resales coming on market, which is pulling eyeballs away. And with the increase in interest rates, that's going to make the builder product a little bit more inviting, albeit, like one of the new projects that just came on in Bothell. Kenmore, Bothell. Oh, right on the border there. look, they're beautiful homes and the builder does a great job, but the lots are below 3,000 square feet, like 2,800 square feet. Well, the house is 3,000 square feet. And they're like, how do you get a 3,000 square foot house on 2,800 square foot lot? Well, it's simple, because it's stacked. And people go, oh, that makes sense. Understand, that is just a takeaway. Is things getting tighter and tighter and tighter, what they can do and how they can make that appeal versus an older home or a resale that comes on where they have 7,000 square feet, 9,000 square feet, 12,000 square feet. People want that little bit of space. We have a client that flat out said, no longer interested in townhomes anymore. I want a backyard. I get that. Gives you a little more space. Gives you, you can stretch your wings out a little bit. That's one of the takeaways that some of the builders are looking at and they have to battle against. And that is clearly being shown on some of their numbers here as they're taking a look at, basically, hey, what's happening in the market. Now, let's move over to bank owned. And this is where I said we're going to start to see what happens when you overprice. Note, we have really in the core areas of Seattle and the east side, you can see there are 2 foreclosures, which is newer construction. And then, of course, we have one that is down in Bryn Mawr area, Tukwila area, but nothing else. This has been situation normal for months, 6-8 months, where we just don't have a lot of inventory. You can see a little bit down south, but this is like a smattering of homes, hardly anything. So when we take a look at our charts here, and we say, okay, George, what are you talking about? Let's take a look at this lower one right in the dead center. So look at that. 40 days more, right? 40 days more on market than what we were year over year. And look at that. They went from last year having 102% of list to sale price down to 98. And actually it was down to 94, but now they've actually bumped that up. Now, the rest of the numbers are pretty innocuous, right? Listen, we talk about, oh my gosh, look, you have a 20% increase. Yeah, that's because we had 8 sold last year and we have 12 this year. Those are tiny, tiny, tiny numbers, okay? But the case in point, when you take a look at days on market versus what you're going to get in your pocket, that's a classic example. Being on market, thinking, oh, we'll test the market. We're going to put that out there and we're going to see what buyers say. Well, I know what they're going to say. They're going to say crickets. You're not going to get showings. The first impression of your home is price. I guarantee it. You do it every day when you go shopping. When you look at something, you'll be thumbing through the Costco magazine. You'll say, oh, that's a good price. I got to go to Costco. Okay. It happens when you go into Costco. You go in to buy a pack of toothpaste, the pack meaning that it comes in about 12. And you think, okay, I'm going to go and get this one thing. You come out like $300 less in your pocket later because you saw other things that were of value. Okay. Now, you do it every day. I guarantee it. And when you're looking at buying a home, that dominant go or no go is absolutely at the forefront. Oh, that's way too high. Oh, no, that's a good deal. Oh, let me look at this. Now let me look at the pictures. Okay. So price is your first impression. And if you think I'll just test the market, you're just going to start losing dollars. Okay. We capitalize on sellers for our clients that have been on market too long, and we get them better pricing for a home. Okay. They get a deal. All right. So with that, if you have any questions, post them down below. We'd love to hear what you guys have to say. In the meantime, have an absolutely beautiful weekend, and I will see you on the next video. Do me a solid here. Subscribe, or at least hit the like button so that other people can get this really great information. I'll see you on the next video. Have fun.